just share my screen. Okay. So is my screen visible?
Yes.
Okay. So wherever you are having any problem, just switch on your mic and you can just let me know what problem you are having, and then we can have a discussion on that also. So to start with, so this is basically financial markets and products, right? So here we are going to discuss all the kinds of markets that exist in the financial world and what all are the products that usually float in the finance world, right? So first to discuss how many types of banking are there. So one is the investment banking. So for example, do you understand Hindi or
I do understand Hindi, but English would be a bit more
sure.
comfortable. But yeah, I can understand. I can pick up on it.
Got it. Just wanted to understand the proportion. So basically, see, there are two kinds of banking. One is the commercial banking and the other is investment banking. So let's say suppose you want to raise some money, right? So you can raise the money through either debt or equity, right? And what do investment banks actually do? They help you go public. So when, for example, you are in need of 500 crores or 1000 crores, so basically the whole IPO process is done by an investment banker. They help you raise funds. Now, what do you understand by commercial banking? So in commercial banking, there is wholesale banking. So if you talk about large corporations like Reliance Industries or maybe Tata, so they deal with large corporations. This is the wholesale banking. And retail banking means consumers or maybe small businesses like mine. So this is retail banking, right? So large banking groups often perform both functions. So basically there is a banking group called as HDFC, right? Or maybe ICICI. So these perform both the functions of commercial banking as well as the investment banking. Both the departments are basically different and they are operated by basically, let's suppose the retail banking is there, the wholesale banking is there. So there are a lot of verticals in a bank, right? So what are the major risks faced by a bank? And these all are the risks that you will study in level 2 as well. So just to give you a brief, one is the credit risk, the other is market risk, operational risk, liquidity risk. So all these are the risks which a bank faces. So credit risk, what do we understand by credit risk? So the counterparty default is known as credit risk. Market risk means risk of loss in the trading book due to changes in market variables like risk, like interest rates, GDP, oil prices, interest rates, equity prices, credit spreads. So what do you understand by credit spreads? So for example, if the risk-free rate is 5% and the bond price and the bond yield of Reliance Industries is, for example, 10%, and it goes from 10% due to certain rise in the risk factors, it goes from 10% to maybe 12%. So there is an increase in the credit spread, right? So this is a market risk for a bank. So what is operational risk? It is the risk faced by a banking organization due to failed processes, people, systems, or external events. So let's say suppose there is a operational failure in a bank, and you basically paid some money to X account, but it credited to Y account, right? So this is the operational failure. So banks follow core banking solutions, right? So operational risk is losses from failed internal processes, people, systems, or external events. Include cyber risk, legal risk, and compliance risk as well. So you might get a question: cyber risk comes under which of these risks? So you need to answer it as operational risk. Again, the same for legal risk or compliance risk, right? So in a MCQ based exam pattern, what you need to understand is you need to be very thorough with what you are studying. So you don't need to study more. Here, less is more. So whatever you're studying, you need to study with utmost depth and you need to understand things really well in order to answer. So for example, they might ask you, they might give you, so counterparty default in derivatives. It is an example of market risk, operational risk, credit risk. So you pick in the credit risk, right? So what do you understand by hedging credit and market risk? So let's suppose how do you hedge credit risk? So something is there known as cost of funds. So whenever you borrow, there is a cost of funds, right? So what is this expected loss? Expected loss is something जो आपको लगता है कि ये लॉस तो मेरे को होने ही वाला है, दिस इज समथिंग दैट आई एम गोइंग टू इनकर. सो फॉर एग्जाम्पल, if I'm giving out 100 crores as loans, I know that 2 crores is something that I will not recover. So that is expected. And one more part is the unexpected part, right? So we always model for the expected part. So expected is something which gets added to the cost, right? So for example, if I'm teaching 500 students, so it might happen that I say that okay, I'm teaching 500 students, so uh, out of 500 students there will be 20 students those who will not give me back my money, right? So I will basically try to incorporate that loss amount in the income in the fees part, basically, right? So this is the expected loss part, right? Again, there is my admin cost, there is my profit. So again, the interest rate charge is 4.2%. So this is very simple, right? So I will always add the expected loss part as a percentage terms in the interest rate that I'm charging, right? Now, how do you hedge the market risk? How do you hedge the market risk? So there are spot transactions. So you pay the money, you get the like whatever you want. So maybe you get the share or maybe the bond. Again, there is forward contract. So in forward contract, तीन चार चीजें fix हो जाती है. So in forward contract, the rate, the time period, the quantity, and the underlying, all things are fixed. In forward and futures contract, you basically have a obligation. In options, you have a right but not a obligation. So if the contract moves in your favor, then only you are going to exercise it, and if it does not, then you're not going to exercise it. So I'll give you a short example. So let's say suppose you do F plus in Bank Nifty. What is Bank Nifty? Bank Nifty is a collection of top 12 banks in India. So you do F plus in Bank Nifty. That means you are bullish on the Bank Nifty index, right? So if you're doing it at 60,000 and the market goes to, let's say suppose 55,000, then you're making a loss of 5,000. And if the lot size is 30, so it is 5,000 into 30. And again, if the price shorts up to 65,000, then you're going to make a profit of 5,000 into 30, which is 1.5 lakhs. So why do we say that futures is having no futures, in options is having lot of options? The main reason being, in futures there is a obligation part, but in options there is no obligation, because you're paying a premium. You're paying a premium for the right. So if the contract does not move in your favor, the maximum loss that you incur in options is limited to the premium that you are paying. Correct? Okay. So again, let's try to understand the capital classifications, right? Let's try to understand the capital classifications. So in capital classifications, there is the financial view, which is the equity. So equity means what? The owner's money, right? It absorbs losses while the bank continues to operate. What do you understand by the financial view? Again, the debt. So debt capital is something protects depositors only after the bank has failed, right? So debt is something which we need to repay. Equity is the owner's capital, right? So equity capital is going concern and debt capital is gone concern, right? So basically, debt capital protects depositors only after the bank has failed, right? So what do you understand by the risk view, which is economic, and risk view, which is regulatory? So what is economic capital? And this is very, very, very crucial and very important for you to understand what is the difference between economic capital and regulatory capital. So economic capital means the bank's own estimate of capital needed to remain solvent and maintain credit rating. So the bank's own estimate of capital, needed to remain solvent and maintain the desired level of credit rating. Okay. Regulatory capital, the minimum amount required by regulators to cover unexpected losses. So there will be two options: to cover expected losses, to cover unexpected losses, and you tick in the unexpected losses. So it is very important to, basically, I'm telling again and again, to go through this PPT again and again and keep on revising the content again and again, right? So to remain solvent and maintain credit rating is the economic capital. Minimum amount required by regulators to cover unexpected losses is the regulatory capital. Again, Basel Committee, very important. So 1988 Basel 1 focus on credit risk harmonization. 1996 amendment added market risk capital. Again 2004 Basel 2 added operational risk capital. 2009 Basel 2.5 update post 2008 crisis for market risk. Basel 3 significantly increased equity capital, added liquidity ratios as well, harmonize the global rules and protect against systemic failure. Systemic failure means if I fail, all my students fail, and हो सकता है कि वो जिस कंपनी में काम कर रहे हो वो भी फेल कर जाए. So basically this kind of systemic जिसको contagion effect हम लोग बोलते हैं, right? We always talk about the contagion effect. So basically harmonize the global rules and protect against systemic failure. So if you basically see, we started with the credit risk harmonization, then we added the market risk capital, then we added the operational risk capital, then we update post 2008 crisis for market risk, then equity capital we increased and added liquidity ratios, right? It is very important for you to learn all these things. Again, if I talk about the Basel III liquidity ratios, right? So liquidity coverage ratio, it is a short term. What is the goal? Ensure enough high quality liquid assets, enough high quality liquid assets to survive a 30-day acute stress scenario. Ratings downgrade, run on deposits, anything can happen. What do you mean by run on deposits? So basically, if I have deposited 5 lakhs and there are 1 lakh people like me who have deposited 5 lakhs, and you estimated that no, not more than 100 people are going to basically withdraw the money in 3 days, and maybe 500 people come and they withdraw the money in 3 days. So that is basically run on the deposits, right? And what do you mean by ratings downgrade? So there are credit rating agencies like Moody's, Fitch. So basically if they downgrade you, right? So in that case, how are you going to survive? So you should have enough high quality liquid assets to survive a 30-day acute stress scenario, right? And net stable funding ratio, it is, as the word suggests, stable funding. So again, long term, which is 1 year, ensure stable funding sources, match the maturity of assets, prevents maturity mismatches, right? So again, the horizon is long term. Goal is to ensure stable funding sources, match the maturity of assets, right? Ensure stable funding sources, match the maturity of assets, and prevents maturity mismatches. So what do we need to do? Duration of assets should match the duration of liabilities, right? So again, very important. What is a banking book and what is a trading book? Again, extremely important for your exam. So what is banking book? Assets held to mature. Like you have seen people, those who have qualified as FRMs, but they don't know what is the difference between a banking book and a trading book, right? So what I have done here is that it took me more than 6 months of time to basically accumulate all the important points and summarize it in a PPT format for you, right? And when you go for maybe any other book, maybe Schweizer, maybe Garp notes, so you will not find it so handy like this resource, right? So let's first understand the banking book. So assets held to maturity, like the loans, not sold day to day, subject to credit risk capital, right? What is the trading book? Assets available for sale trading, mark to market daily, subject to market risk capital, and includes any instrument with a dedicated trading desk. So it's very simple to understand, right? Now, what do you understand by deposit insurance and moral hazard? I'll tell you. In the morning, I had a conversation with one of my prospective students. So she asked me that, sir, I am going to give 30 mocks. I am going to give 30 mocks. So moral hazard means that, for example, you have taken an insurance, right? So that does not mean that you will leave your home, you will not close the gates, or you will drive the car in a very rash manner because you have taken insurance. So basically the solution, now you need to understand that government guarantees compensation if a bank fails, right? So prevent bank run. So the government, so the consumers currently are having lots and lots of confidence on the banking system. But अगर बैंक फेल हो जाएगा तो लोग अपना पैसा कहां रखेंगे, आप ये सोचो, राइट? Because funds are insured, depositors stop monitoring the bank. Banks may take excessive risk knowing the government absorbs the losses. If you know that नहीं, मैं कोई भी गलती करूंगा सामने वाला मेरे को बचा लेगा, तो एक बार बचाएगा, दो बार बचाएगा, हर बार थोड़ी बचाएगा, राइट? So investment banking financing arrangements, right? So दो टाइप का चीज होता है इसमें. One is the private placement sold to small number of qualified investors, close to public, cheaper भी होता है, faster भी होता है, कोई इसमें टाइप का like marketing नहीं होता है, right? So what is public offering? Sold to general public, requires regulatory approval, Securities Exchange Commission, IPOs भी इसी में आता है. So public offering के क्या क्या risks है? What is the risk of public offering? Best efforts versus firm commitment. So bank acts as an agent, sells what it can, unsold inventory returns to issuer. Low risk for the bank. But firm commitment means what? Bank will tell that no, I am going to underwrite 100% of the issue. जो नहीं बिकेगा वो मैं वापस ले लूंगा. बैंक ये बोलता है. Bank acts as underwriter oblique principal, buys entire issue to resell. Bank holds unsold inventory, high risk for the bank. So right. Yeah. So now we will talk about IPO pricing and Dutch auction. So is it clear till now? Yes, no? Till now, was it clear?
Yes, sir, all clear.
Okay. So basically now we'll talk about the IPO pricing and Dutch auctions. So traditional IPO में क्या होता था? Price slightly below value to ensure success, right? So what happens is many people they invest in IPOs and जो listing gains होता है सब लोग अपना the people they sell it in that, right? But what do you mean by Dutch auctions? Market clears at lowest successful bid. Everyone pays the clearing price. So for example, we have placed the bid at maybe 5 rupees, 7 rupees and 9 rupees, right? So what will happen is that you will find the matching price. It's very simple. You need to understand. So market clears at lowest successful bid. So for example, you have bid, we have basically purchase price of 579, right? So the first thing will go to 9 and then it will go to 7 and then if something is left, then it will go to 5. So that was the Dutch system of auction. Like I will just remove the word Dutch and auction, like how it is done in an auction, right? So for example, just think how players are sold in IPL. So it's basically as simple as that. So what are the potential conflicts of interest? Investment advice. Pushing customers to buy securities sold by the bank's own IB division even if unsuitable. आपने सामने वाले को बेच दिया, राइट? बट उसका कोई आप समझ लो सामने वाले का रिस्क एपेटाइट है बॉन्ड खरीदने का, बट आपने उसको डेरिवेटिव्स एफएनओ चिपका दिया, राइट? सो रिसर्च इंडिपेंडेंस. इशूइंग बाय ratings to please investment banking clients rather than informing investors honestly. So basically आपने क्या किया है, इन्वेस्टर्स को ऑनेस्टली नहीं बताया. आपने बोला है कि भाई मेरा ये रिसर्च है, ये खरीद लो, बट वो एक्चुअल में आपको मालूम है कि अंदर से वो चीज खोखला है, राइट? लेंडिंग वर्सेस इशुएंस. यूजिंग आईपीओ प्रोसीड्स टू पे ऑफ बैड लोन्स हेल्ड बाय द कमर्शियल बैंकिंग आर्म. तो बेसिकली आईपीओ से जो पैसा आया आप क्या कर रहे हो, उससे अपना पुराना लोन वगैरह चुका दे रहे हो, बट कि आपको जो पर्पस के लिए आपने पैसा उठाया था आप वो काम नहीं कर रहे हो, राइट? मैनेजिंग कॉन्फ्लिक्ट्स. सो कॉन्सेप्ट इज व्हाट कि भाई आप जो कमर्शियल बैंकिंग है एंड जो सिक्योरिटी सर्विसेज है आप चाइनीज वॉल रखो इन्वेस्टमेंट बैंकिंग डिवीजन से. ऐसा नहीं होना चाहिए कि इंफॉर्मेशन फ्लो करेगा, राइट? क्योंकि इससे क्या होगा ना कि फिर फेयरनेस नहीं आएगा, ट्रांसपेरेंसी बेसिकली जिसको बोलते हैं. So strict internal controls to prevent flow of material non-public information, right? Massive fines and reputational damage लगना चाहिए कि भाई नहीं इसका इन्वेस्टमेंट बैंकिंग डिवीजन कमर्शियल बैंकिंग से मिला हुआ है, ठीक है ना? वैसा नहीं होना चाहिए. Now what do you actually understand by originate to distribute model? So what happens is that I will just tell you how the asset backed securities work. So basically क्या होता है, आज मेरे पास मेरा घर है तो मैं क्या बोलता हूँ बैंक के पास में कि ये मेरा एसेट है, आप इसको दे के मेरे को थोड़ा लोन दे दो. 2 करोड़ का मेरा घर है, एंड बैंक मेरे को बोलेगा कि ठीक है आप 1.5 करोड़ का लोन ले लीजिए, तो एसेट दिखा के लोन लिया. तो बैंक, व्हाट इज द एसेट फॉर अ बैंक? The bank's asset are the loans that the bank has given, right? So bank will say, see, I am having loans given to customers, it will come back and then I'm going to pay you your money, you give me more loans. So the bank is basically repackaging all the assets and all the mortgages. It is known as asset backed security and the mortgage backed security. So it is repackaged and it is divided into tranches: senior tranche, mezzanine tranche, and junior tranche. So when you get the loan proceeds in form of EMI, the senior tranche is getting filled, then the mezzanine tranche, and then the junk category, which is the junior tranche, is getting filled. So bank creates the initial loan. Loans are packaged into a security. Security is sold to investors in the market. So allows bank to lend more, creates a secondary market for loans. Banks doesn't keep risk, disconnect between originator and risk holder. So for example, let's say suppose what happened in the credit crisis in the US in 2008 was कि जिनका EMI आना था EMI आया नहीं, तो जिनको पैसा चुकाना था उनको पैसा गया नहीं, पूरा मार्केट कोलैप्स हो गया, and too big to fail banks like the Lehman Brothers, they also collapsed, right? So it is very important concept, ABS and MBS, right? So is it clear till now? Yes, no? Was first chapter clear?
Yeah, sir. So I just have like everything is clear, but Dutch auction, right? Just that part.
Hmm.
It is like I even when I was studying, I felt it a bit hard to
You just
solve it.
try to think of a normal auction, right?
It's
So,
just
for
like now.
example, if I am having 1,000 shares to allocate, you told that I will buy 500 shares at 9 rupees. Someone told 500 shares at 7 rupees, and someone told 500 shares at 5 rupees. So 5 rupees person is not going to get the share. 7
Yeah.
rupees and 9 rupees will get the share. It's as simple as that.
Okay.
Hmm? So आपका total revenue जिसमें maximize होगा वो वाला option select करोगे.
Just like a simple option.
हाँ. So now we'll talk about insurance companies and pension plans, right? Okay. So what are the pillars of basically insurance industry? So there is life insurance, there is property and casualty, and there is health insurance. So protection against financial loss resulting from death, long-term contracts. Life insurance में जो contracts होते हैं वो long-term होते हैं. So for example, if I'm a person age 29, I have taken a term policy till 60 or maybe 80. So the insurance company will keep getting premiums till the time I'm alive, and when the contingent event arises, and then basically the insurance company is going to pay a claim to my dependents, right? So property and casualty is basically motor. So everything except the life insurance comes under the general insurance, right? So protection against damage to property and legal liability, these are short-term contracts, right? Again, health insurance, coverage for medical expenses and illness, high frequency claims. What is mortality risk and longevity risk? So mortality risk is, for example, let's suppose I had an estimate that 10 people are going to die, but 20 people died. So this is a mortality risk. What is longevity risk? I had an estimate that I am going to live for maybe 40 years, but I live for 60 years. So this is the longevity risk for the companies. So dying sooner than expected, loss of future income for dependents, life insurance. Living longer than expected, outliving assets and savings, solution is annuities. So how annuity is the solution? So you know that your health condition is better than others, right? So you go to an insurance company, pick up an annuity product where they estimate that you are going to live for 40 years, but you know you are going to live for 60 plus years. So in that case, annuity product will always be suitable to you. So outliving assets and savings, then you need to go and select an annuity product from the insurance company. Temporary coverage, term life insurance. So no savings or investment component is there. Covers a specific period, 10, 20, 30 years. Cost efficient, generally the least expensive option per dollar of coverage. And benefits are paid only if the policyholder dies within the specified term. So what is permanent coverage? So there is whole life. Whenever you die, you get the claim. Fixed premiums are there. Guaranteed death benefit is there. Builds cash value. Low risk for policyholder. Universal life, flexible premiums, flexible death benefits, separation of insurance and savings. So separation of insurance and savings is basically you can think this of as an endowment assurance product. So if you die before the term, you get the benefit when you die, and if you die after the term, then at the end of the term you are surviving and you get the pure endowment part. So basically the savings part. So variable life is policyholder chooses investment mix, stocks and bonds. You can consider this as a ULIP product, which is unit linked investment plan. Investment risk shifts to policyholder, right? So managing longevity risk with annuities. So you have a lump sum, you give it to the insurance company, you get periodic income, right? So prevents outliving assets that you basically you don't have any assets left at a certain point in time if you're spending regularly. So prevents outliving assets. So annuity can be deferred also, it can be immediate also. Insurer bears the risk of the individual living longer than expected. So what is PNC insurance? So PNC insurance, property, protection against physical asset damage, fire, theft, protection against legal responsibility for harm to others, right? Uh, Annual contracts generally 1 year, premiums reset yearly based on risk. So there is something concept called as no claim bonus. So for example, if you haven't claimed for years, then the company might increase your sum assured. So auto, homeowners, etc. So life versus PNC, we have made a comparison here. So in life insurance, the duration is long-term liabilities. Predictability is highly predictable payouts through the mortality tables. So inflation is less sensitive to short-term inflation. So less sensitive to short-term inflation because these are contracts of long-term. So we try to invest in real assets, right? Our main agenda in financial risk management is to match the assets and liabilities, right? In PNC, short-term liabilities, short tail, predictability is unpredictable, lumpy payouts, catastrophic risk can happen at any point in time, like the COVID, hurricanes, tornadoes, bridge collapsing, anything can happen in property and casualty, right? So if you talk about inflation, highly sensitive to repair costs and medical inflation. Highly sensitive to repair costs and medical inflation. So it might happen that normally if you see in health insurance premiums, they hike it in once in every, let's suppose, 2 years or maybe 3 years or maybe 5 years. And it was that year when the premium got hiked. So these are highly sensitive to repair costs and medical inflation costs. So health insurance and morbidity risk. So if you talk about health insurance and morbidity risks, covers medical expenses resulting from illness or injury. Morbidity risk is what? The risk of illness, frequency and severity. So what is the key risk? What is the key risk? Key risk is the morbidity risk, the risk of illness, frequency and severity. Like for example, you have someone who gets ill very frequently. So that is again a bad risk to health company. So cost inflation and moral hazard, that people don't take their health seriously because they're having a health insurance policy and they keep going out, they keep eating out. So things like that. So behavioral risk, moral hazard. So the tendency for insurance coverage to alter an individual's behavior, making them less careful. So this MacBook through which I'm teaching, or maybe the iPad through which I'm teaching, I am having Apple Care. So it took me approximately 25% of the cost price of the product for the Apple Care of 2 years. So that does not mean that I will keep throwing my iPad. I'll keep using my MacBook in a very rash manner. So that does not, because I'm insured, I bear less downside risk. So the company is also having the concept of deductibles, like the first some part of the cost will be beared by the policyholder and the above part will be beared by the insurance company. Or maybe when you claim too much, then the next time when you go and take the policy, then they might hike the premiums by 30, 40, 50%, right? So what is adverse selection? So let's suppose I tell that I will only take candidates for FRM, those who are having 90 plus in maths. So it's a quant based paper. So I know that a student who has got 90 plus in maths will be having better performance in FRM, right? So I do this kind of demarcation, but someone other coaching institute, they don't do it. So what will happen is the other company is having the problem of adverse selection. So what do you mean by adverse selection is you face the problem of bad risk. So there is a company who differentiates on the basis of smoker and non-smoker, who differentiates on the basis of income or maybe talent. So basically you recognize the risk factors really well. The tendency for those with the highest risk to be the most eager to buy the insurance. The insurer cannot perfectly distinguish between high risk from low risk applicants. Medical exams, pre-existing condition clauses, questionnaires, etc. can also help you. So smoker, non-smoker, again, income, housing. So for example, I will only take students, those who are studying in the top 20 colleges in India. So basically, this is the kind of, I'm basically making my population more healthy, right? So this was all about the insurance wala part. So pension plans, if you talk about the funding retirement plan, so there are two kinds of benefits. One is a defined benefit and the other is a defined contribution. So defined benefit means what? Employer promises a specific output, maybe 1% of your salary for each completed year of service. Defined contribution is you also contribute, employer also contributes, and it depends on the asset growth, that how much the assets are going to accumulate. So employer-employee contribute a specific input. So pension funds are established by employers to facilitate employee retirement income, right? So pension funds are established by employers to facilitate employee retirement income. Okay. So the defined benefit plans, the promise. So benefit calculated by formula, years of service, as I already told, final salary into multiplier. So retiree knows exactly the payout amount. Risk bearer is the employer, because let's suppose if the assets don't grow much, then employer is going to cover the balance part. If investments underperform, the employer must cover the shortfall. Employer bears the longevity risk. So again, the defined contribution plans, it's very simple. Fixed contribution to an individual account. Final benefit depends on investment performance. Payout is unknown. Only the input is defined. The risk bearer is employee. If the market crashes, the employee retires with less. Employee bears longevity risk. So the definition is benefit is defined. Contribution is defined here. Investment risk is employer-employee. Longevity risk is employer-employee. Portability, difficult to transfer, highly portable. Defined contribution is highly portable and defined benefit is difficult to transfer. Now let's talk about the regulatory capital requirements. So if you talk about the purpose, capital acts as a buffer to absorb unexpected losses and protect policyholders. So if you talk about life insurance, capital reflects stable mortality tables, capital reflects stable mortality tables, but must account for asset liability mismatch. So for example, if you have a lot of free capital in an insurance company, then only you will be able to deviate from the asset liability matching principle. So if not, then you need to closely match your liabilities. PNC insurance requires higher liquidity and capital buffers relative to premiums because contracts are short term. Reason is catastrophe risk, low frequency, high severity events, because these don't occur on a regular basis, but when they occur, the loss is very heavy, makes PNC claims highly unpredictable. Just give me a moment. Okay. So is my screen visible? Yes,
Yes,
no?
sir.
Okay,
Yeah.
great. Great. So now if you talk about the safety net, right, which is the guarantee systems. I'm really sorry for the spelling of guarantee. So no federal FDIC for insurers. So what do you understand by the safety net? So state level guarantee funds, funding mechanism is post event assessment. If an insurer fails, surviving insurers are charged a fee to cover the claims. So for example, let's say suppose there are 10 insurance companies and one of the insurance company fails. Then the other 9 insurance companies are going to pay a fee to cover the claims of the insurance company which has failed. So unlike banks which are pre-funded, insurance protection is often funded after the failure occurs. So if they ask you about the safety net, now you know. So there is no federal FDIC for insurers, right? How is the structure like? State level guarantee funds. And the funding mechanism is post-event assessment. If an insurer fails, surviving insurers are charged a fee to cover the claims. So banks are pre-funded and insurance companies are post-funded. So DB is again employer risk and DC is again employee risk, right? So, uh, so what is the role of the fund manager? So acting as agents to invested pooled capital for specific risk return objectives. So what is the expertise? Professional research is there, market knowledge is there, and access to sophisticated strategies is there. Individuals invest in the access to sophisticated strategies which the individual investors lack. So if we talk about the diversification part, pooling resources to hold a broader basket of assets, significantly reducing idiosyncratic or the specific risk. So what is diversification all about? So pooling of resources is there to hold a broader basket of assets, significantly reducing idiosyncratic risk. What is the idiosyncratic risk? So if you talk about the idiosyncratic risk, uh, so there is specific risk. So my firm might have a problem of promoter holding, or maybe there is some specific which is company specific, right? So it is idiosyncratic risk. So specific to company. So for example, I had some bad decisions in my company this year, and that is a specific risk, not industry risk. So economies of scale, lower transaction costs, and better execution prices compared to retail trading. So open-end mutual funds. So what is open-end mutual funds? Again, very, very important. So what is the structure like? Dynamic pool is there. Fund grows strings based on demand. Share mechanics. No fixed number of shares. New shares created on entry, retired on exit. So liquidity. Investors trade directly with the fund. Pricing. Transactions occur once daily at market close. Price basis is executed at NAV, which is net asset value. Again, it's very, very, very important to understand what is open-end mutual funds. So there is a dynamic pool. Fund grows and shrinks based on demand. So what do you understand by share mechanics? There is no fixed number of shares. New shares created on entry, retired on exit. So open-end mutual funds is there. So as much as there is a demand, the new shares will be created. So again, it is very important. You need to basically learn all these things. You should know before sitting for the exam that these are the things, that what is the share mechanics. There is no fixed number of shares. Liquidity, investors trade directly with the fund, not on an exchange. Pricing, transactions occur once daily at market close, and it is executed at net asset value. Closed end is what? Fixed pool of capital, as the name suggests. Capital raised via initial public offering. Fixed number of shares, no new shares created after IPO. Shares trade on secondary exchanges between investors. Price determined by supply and demand, not just asset value. Premium means what? Market price is greater than NAV. Discount means what? Market price is less than NAV, which is the net asset value.
So
All,
just one thing.
yeah, sure.
Yeah, so closed-end mutual funds, basically we're saying after the NFO, we are closing the funds and we are not taking any new investors, right?
Yeah. So what will happen is, that is why they're not trading at the net asset value. There is a market price.
Market.
So if there is heavy demand, then it will trade at a premium, and if there is low demand, then it will trade at a discount. The number of shares will remain fixed. So no new shares are created after IPO. There's fixed number of shares. But here, there were shares more and less created. Like so, new shares created on entry and retired on exit. It's like that. Is it okay? Can we go ahead?
Yes, sir.
Yeah. So now this is very important. You might have heard like bank Bs, Nifty Bs, Gold Bs. So this is exchange traded funds. So this is a hybrid model, combines open-end and closed-end features, tracks an index or a sector. So trades intraday on exchanges, buy, sell anytime. Authorized participants create, redeem shares to keep price aligned with the NAV. Tax efficiency, in-kind creation, redemption minimizes capital gains taxes. Lower fees, so generally lower expense ratios. So creation, redemption minimizes capital gains taxes. So how is this? So let's say suppose I'll not agree much with this tax efficiency point. So see, in actually closed ended, the market price and the NAV is not the same, right? But this is a problem actually. So that has been captured by the exchange traded fund. So it will move very closely in line with the NAV. So this is not something that the capital gains tax will reduce, but it will be efficient, I would like to say, right? So this point is very important, to keep price aligned with the NAV, right? Tracks an index, which is for example gold or maybe silver or maybe Nifty or maybe Bank Nifty. So there is Bank Bs, Gold Bs, Silver Bs. You can just see. So actually in India you cannot buy an index. You can buy ETFs which track the index. So, if you talk about the comparison between mutual funds and ETFs, so there is open end, closed end, and ETFs. So shares outstanding is variable, fixed number again variable. Pricing basis is NAV, supply and demand again market price, which is close to NAV. Trading time is end of day, intraday, intraday. So this is the feature that they have adopted from closed end fund. You will get a question: what feature of closed end fund is there in ETF? So it is a trade timing. Price versus value always trades at NAV, premium or discount, minimal premium and discount because it is very close to the NAV. Management style is often active, and often passive. So because they track the index. So again, this chart is extremely important for your exam. So if you talk, yeah.
You had mentioned timing, right? The feature of closed-ended fund, which is there in ETF, is timing, right? Trade
Yeah.
timing.
Yeah, trade timing. So closed-ended fund is again intraday, and ETF is also. You can see my screen, right?
Yeah, I can see.
So intraday and intraday.
Got it. Yeah.
So calculating net asset value. So how do you calculate the net asset value? So it is total market value of assets less total liabilities by number of shares outstanding. So in assets, you take the stocks, bonds, cash, and accrued income. In liabilities, again, you take accrued fees, expenses owed, pending payouts, etc. So if we talk about the shares, so the total count held by all investors at that moment. Okay. For open-end funds, this calculation determines the exact price an investor pays to enter or exit. So this is all that I have today for you. What we can do is next day we can start this hedge fund, right? So what you need to do is just wait. So what you need to do is today you just practice whatever we have done. Just go through the books and practice all the questions which are there in the LMS, right? So the next day when we are meeting, first we will do the next set of topics. Then we are going to discuss the doubts that you're having in the tilt topics. So you need to follow the questions which are there in the LMS. Extremely important. If you want to read the book, very good. But if not, again, not a issue. Our first agenda is to complete the curriculum very nicely. So that is why we have launched this 50 hours of masterclass, and that is very important for you to cover through the PPTs. And since you know that book 2 is again very practical, so that is taken in a different format. But for book 1, book 3, and book 4, you can refer to the PPTs. It is very nicely done, right? And do all the questions which are there in the LMS, and then we will analyze the report as well. So that is it for today. And next class mostly will be either on the weekend or next weekday we can start, right? So my target will be to get done by maybe March mid, okay? Because we are having the exams in May and August. So just do these topics first, and then we can discuss the next set of topics the next year. Okay, cool.
Yeah. So one thing.
Yeah.
So what we covered three chapters. So I currently am on book two. Okay, I've not started book three and book four of yet. So like before coming for the class, I just skimmed through the Schwezer notes. So you're saying that instead of going into the GARB books, I can just refer to the PPT and do elements. That would be more
Yeah, you can just
efficient, is it?
skim through the Schweizer notes once just to mark something. Was it difficult to understand? It was very easy, I think.
Yeah, it was very easy. The only part I found difficult was one was Dutch auction and second one is the mortality table problem. That's it.
Yeah, just you can go through that through the book, and whatever queries, then we can take this, no issue.
Yeah, sure.
Okay.
Okay, sir.